All right. Hello and welcome, everyone. Thank you for joining us. I'm Alma Inocentes, your host for today's webinar on the Paycheck Protection Program, Round 2. This is presented by the Philippine American Chamber of Commerce of Metro Washington, D.C., or PACC-DC, in partnership with the Asian Pacific Islander American Chamber of Commerce and Entrepreneurs, or ACE for short. This is our first collaboration with ACE, and we are very happy to forge this partnership as their goals align with ours in giving voice to the business interests of our chamber members. I'd like to call on our chamber president now to say a few words. She's been in the real estate business for over 20 years and has won many awards for her top-notch performance. Christina Season of Compass Season Homes. Christina?
Hello, good afternoon, everybody. I'd like to thank, of course, ACE and our sponsors and then today's presenters for really educating our members and also, of course, business owners for the PPP second round and the business retention program. Again, I'd like to thank all the people who are supportive of this program. And please check us out at pacc-dc.org. Our mission and vision is to promote Filipino American interests in establishing an entrepreneurship and promoting business opportunities in the community. Again, thank you so much, and we'd love to see you soon. Bye-bye.
Thank you, Christina. And let me correct myself. That's Asian Pacific Islander American Chamber of Commerce and Entrepreneurship, or ACE.
Yes,
I stopped at
ACE.
entrepreneurs earlier. Sorry.
Okay.
Sorry, Janet. Let me introduce Janet.
Thank you, Janet. Appreciate it. Yes.
Of course,
And
thank
here
you
to give
guys.
us a few words is ACE's project manager, Janet Alikpala. Janet?
Thank you, Alma, and thank you, Christina, for having us on today's program. As Alma said, I am the project and partnership manager for Asian Pacific Islander American Chamber of Commerce and Entrepreneurship, also known as National ACE. I'm also a proud Filipino American, and I'm happy to be on this webinar today. A little bit about National ACE. We're a national nonprofit organization whose mission is to serve as a strong advocate for AAPI business interests and affect positive change on all issues that enhance and advance the goals and aspirations of AAPI business owners. For the past few months, we've worked closer than ever with our national network of more than 65 affiliate chambers and minority business partners across the country to ensure that AAPI business owners have the most accurate and up-to-date information about the important resources that are available to our community during this global pandemic. Our newest partnership is with Philippine Chamber of Commerce of Metro DC, and I want to thank Christina Cizan, Alma Inocentes, and our CPA experts from KRD Limited, Jean Barinholtz, and Paul Wilkin for making time to participate and bring members together to listen to today's discussion on navigating PPP Round 2 and current changes to employee retention credit. We are now just starting to see the impact of COVID-19 and what it has done to the AAPI business community. National ACE, along with the U.S. Black Chamber and U.S. Hispanic Chamber, has commissioned the largest national survey on the impact of COVID-19 on small businesses with focus on Black, Hispanic, and AAPI businesses. The recent report of our national survey has shown the devastating impact on AAPI businesses. 84% said that COVID-19 has had a negative impact on their business, and 84% is a huge number. I just want to point that out. 60% of those that did not apply for federal relief said that they didn't apply because they didn't think they were eligible. So I'm glad we're hosting this discussion today because we are eligible. We need to take advantage of it. 53% reported an increased debt to their business operations, and 78% believe federal, state, and local grants would provide the greatest relief to their small business. This data survey is important, and it shows how minority businesses, particularly AAPI businesses, were severely impacted by this pandemic. And this data is being used to inform and educate lawmakers on Capitol Hill of the challenges and opportunities AAPI business owners are facing across the country. National ACE has instituted a program to help tackle many of these issues, including helping individual businesses like yours with financial assistance, as well as helping individual businesses restart their operations safely and strategically. If your business is in need of complimentary one-on-one consulting or other resources, please contact us through our website. We are an extended partner for PACC-DC. Go to our website at acesmallbusiness.org. I will put that in the chat. All of our services are free of charge. Our consultants are ready to help, and we're here to help. So again, thank you. We look forward to hearing today's discussion. Thank you to PACC-DC and KRD Limited for being available to talk with our small business and entrepreneurial community. Have a great discussion today. Thanks so much.
Thank you, Janet. And probably you'll be one of the callers would be me. I call assistance from National ACE. And to our attendees and viewers, we will have a question and answer portion after we hear from our speakers. You may type in your questions in the Q&A box of the Zoom meeting. And questions from viewers on FB Live will also be entertained if we have time. Please type in your questions in the comments section of the live feed on PACC-DC's Facebook page. All right, I'm sure our attendees and viewers are excited to hear from our speakers. Joining us tonight are two speakers from the accounting firm KRD Limited. We have Jean Barinholtz and Paul Wilkin. Jean manages KRD's client accounting and advisory services group. His substantial knowledge of accounting and business enables him to advise clients on a wide array of financial concerns, including tax strategies, tax incentives and entitlements, business consulting, and litigation support. He began his career in corporate accounting, moved to a small CPA firm, and started his own firm in 1987. Jean graduated from Northern Illinois University with a Bachelor of Science in Accounting. He is a certified public accountant and a member of the AICPA and Illinois CPA Society. And Paul has over 30 years in public accounting. He is a certified public accountant as well, licensed in the state of Illinois. Paul has extensive experience working with small to medium-sized businesses and their owners. He earned his Bachelor of Science in Accountancy at the University of Illinois and his master's degree in taxation from DePaul University. Paul is a member of the AICPA and Illinois CPA Society. So folks, they've been speaking all over the place at similar webinars, so they definitely know what they're talking about. Welcome, Jean and Paul, and thank you for agreeing to our webinar today. We certainly appreciate the help navigating through this PPP round 2. Right, floor is yours, guys.
Great, thank you. Thank you so much. Thank you, Oma. Thank you, Janet. Thank you, Christina. We want to thank PACC-DC. We want to thank ACE and everyone for inviting us to participate in this webinar today. And we want to thank all of you who are out there, either in the Zoom meeting or Facebook Live listening to us. This is a pleasure. Thank you very much. So my name is Jean Barinholtz. I'm a partner shareholder at KRD. We're a tax audit and advisory firm with offices in Schaumburg, Illinois and Chicago, Illinois. I'm here today with my colleague, Paul Wilkin. He's one of our tax managers. And we're going to talk today primarily about the PPP and the PPP2. There are a couple of other programs out there that may be of interest to all of you. The economic injury disaster loans, the EIDLs, which we will not be covering in this webinar today. And then we also want to make you aware of the employee retention credit, the ERC, which we will not be covering today. But I do want to highlight the importance of the interplay of the ERC with the PPP loans. So they do have some kind of an interplay in there. And these are all good things. None of this is bad. None of this gets you in trouble. So at the start, we're going to encourage you to engage your professionals, talk to your advisors. That's what they're there for. They're there to help you. Don't try to go any of this alone. It's complicated. You can get tripped up pretty easily. And with the interplay with a bunch of different laws, you want to be able to take advantage of the entitlements or incentives that you have coming to you. So again, engage your advisors. Don't go this alone. So with that, let's start. We got a lot of material to get through. So you can thumb through. Next slide, please. We're going to talk about the PPP loans after the Consolidated Appropriations Act. So next slide and we'll get going. So we had 3 pieces of major legislation that addressed PPP loans. We had the CARES Act back in March last year. We had the PPP Flexibility Act that was in June of last year. And then finally, we had the Consolidated Appropriations Act, which was that law that was signed at the end of the year before we came into the new year. All 3 of these pieces of legislation address PPP, the eligibility requirements, the eligible expenses, the forgiveness requirements, et cetera. So these are the 3 pieces of legislation that gave us this PPP funding. PPP, Paycheck Protection Program is what it's called, okay? So the first thing that I get asked a lot is, can I still get a PPP loan? The Paycheck Protection Act the PPP Flexibility Act that was passed back in June, that's the bill that expanded the timeline and gave additional funds to the PPP program after the funds ran out early on in March and April last year. So the Flexibility Act back in June said, hey, we're going to let you apply for PPP forgiveness, for PPP funds through August 8th of 2020, okay? And then the program was going to end. So at the time the program ended at August 8th of 2020, there was about $134 billion of funds available in the program. When the Consolidated Appropriations Act was signed in December, there was an additional $284.5 billion allocated to this program. Of that $284.5 billion that was allocated to the program, you can see in the slide here below for your reference, there was about $105 billion of set-asides, basically for those smaller businesses, those smaller communities, those smaller financial institutions that really kind of got shut out of the first round of PPP. So there were specific set-asides in the Consolidated Appropriations Act for these types of entities, okay? So they get an equal shot, because when these things first came out about a year ago, there was a lot of backlash about only the bank's best customers getting the loans, only the bank helping their best customers applying, help them through the process. So they wanted to make sure in this go around that this was equally available to everybody, and especially the small businesses, which were those that were hit the hardest. Next slide, please. So we have, when this program opened, and it opened about January 11th, there was a $418.5 billion in funds appropriated. We have those set-asides that we talked about in the previous slides. So that meant that there was about $313 billion left for the small companies that weren't part of this $105 billion of set-asides, okay? Some basic requirements. To be eligible for PPP funds, you must have been in operation as of February 15th, 2020. Businesses that were opened after then do not qualify for this program, okay? There are other programs you can qualify for, but not this one. And there was something that created a lot of anxiety when the program first came out. There's these certifications that you had to swear to, and the most anxiety striking one was that there's a statement that you signed that says, economic uncertainty makes it necessary for me to apply for this loan. So don't let that certification scare you, okay? Because if you tell me you have economic certainty, then I'm going to want to be a part of your business, because nobody has economic certainty and there's always economic uncertainty. So don't let these certifications scare you, okay? Next slide, please. So, like I said, especially in regards to these set-asides, on Monday, the White House announced that as of yesterday, for 2 weeks, for a solid 2 weeks, that the PPP program will not be accepting any applications for any applicants that have more than 20 employees. So we're at the very beginning right now of a 2-week set aside, so that those smaller businesses, those underserved businesses, those smaller banks, those smaller communities have access to these funds. So if you've got somebody that, if you're a company that's larger than 20 employees, then you're going to have to wait until March 9th to get back into the system and apply for this. So this is something that just happened this week, okay? And again, we've got all these set-asides for very small companies. We have set-asides for sole proprietors and independent contractors. So there's a lot going on right now to try to help serve those that were not served in the past and those who typically tend to be underserved. Next slide, please. So We have PPP round one, which is what came out in March of last year. And we have PPP round two, which is what just came out in December of this year, okay? If you have not gone through PPP round one, you are not eligible for PPP round two. You must go through PPP round one under the rules that existed for PPP round one first, before you can be eligible for PPP two. And yes, PPP one is still eligible as a part of these funds that have been set aside, okay? So there's some changes that apply to the second round only, and then there's some changes that retroactively apply to both rounds of PPP funding. So first, we're going to go over the changes that apply to all PPP loans. So first of all, obviously the program didn't end on August 8th. It's now been expanded to March 31st. So that was one of the things that applies to both sets of PPP loans. In the original PPP loans that came out in the CARES Act, you were given an 8-week covered period. This is the period that you were given from the date you got the funds forward to spend the money on eligible expenses, okay? When the PPP Flexibility Act came out in June, they expanded that to 24 weeks. So it's to imply that you had either 8 weeks or 24 weeks and that there was no middle ground. That is no longer true. You got 2.5 months worth of money. How could you make it last 24 weeks and maintain your employee headcount for 24 weeks? So now your covered period, the amount of time with which you have to spend the money on eligible expenses, is anywhere between 8 and 24 weeks at your choice. So if you receive PPP funds and in week 13, you've expended them all, that's your covered period, 13 weeks, you're done. There's nothing else you have to comply with, okay? When the definitions first came out of eligible expenses for receiving PPP funds and eligible expenditures of PPP funds, there was a lot of confusion about the health insurance portion of that you were allowed to A, claim funds based on, and B, expend the funds on. So typically, we were just using health insurance premiums, the employer's share only, not, you cannot count the portion that may be under a 125 plan that's being withheld from your employees' paychecks, your employer cost only. But the healthcare payments have now been expanded to include not only health, but life, disability, vision, and dental benefits as well. When PPP first came out, there was a very specified list of eligible expenses that you were allowed to spend the money on, which we'll go over later. That eligible list of expenses has been expanded for covered operations expenses, covered property damage costs, supplier costs, and worker protection expenditures. And again, these are all retroactive to the first round of PPP. But we also do have to keep in mind with the PPP funds that when we're getting these funds and using these funds, we must use at least 60% of these funds for payroll and payroll related costs, okay? So although the non-payroll cost portions have been expanded, again, let's still keep in mind that that can only be 40% of your eligible expenses. Next slide, please. So let's get into some definitions, key definitions in this, which is basis for your eligibility for the funds and how you compute how much you receive in funds, and also for your eligible expenditures, your allowable expenditures. So payroll costs are pretty simple. Wages, salaries, commissions, your gross pay that you pay to your employees. Your payroll costs also include the employer's share of these insurance premiums. So in here, when we say group healthcare benefits, we also mean the expanded definition of life, vision, dental, and disability as well. Those are part of your payroll costs. Your retirement plan costs, not the plan administration costs, but the actual benefits themselves. So like if you have matching in a 401k or a profit sharing or a pension plan, you as the employer, your share of those costs are eligible payroll costs, okay? State and local taxes based on compensation, these are generally your state unemployment taxes. If you are operating as a sole proprietor, an independent contractor, a single member LLC, that's going to be your net income from that activity. And partners in a partnership, your payroll costs are going to be defined as your self-employment income of partners in a partnership. Next slide, please. Okay, this is an important concept. Payroll costs. Payroll costs are limited to $100,000 per person per year for purposes of the computations of the funds you're eligible to receive and for the computation of your forgiveness, okay? Limited to $100,000 per person per year. Those of you who went through PPP-1, sometimes there was some confusion at the banking side of the world. The banks are the ones administering this program. Some banks completely misunderstood this provision and they eliminated anybody who was $100,000 or more per year and didn't let them be counted in the wage base for purposes of obtaining the funds. That is completely wrong, okay? So we just have a cap. So if you're paying somebody $150,000 a year for purposes of this computation, you have to cap them at 100. So for employees other than owners, the maximum that you could pay somebody and be eligible for forgiveness purposes, if you use a 24-week covered period, would be $46,154. And you can see how we computed it there. 24 out of 52 weeks times $100,000 equals $46,154. We're not telling you you can't pay your employees more than that if you have some high paid employees, but what we're telling you is when you get down to the forgiveness calculation, you're going to have a limit on what qualifies for forgiveness, okay? That $46,000 cap is for your non-owner employees, okay? Because when I have owner employees or sole proprietors, then I'm limited to 2.5 months of $100,000, which is $20,833. Again, you could pay more than that, but when it comes to the computation for what's eligible for forgiveness for the owners or for your sole proprietors or partners in a partnerships or independent contractors, you're going to be limited to $20,833. And then we're giving you another example. Like, let's say that through the 16th week, you've burned through all the funds and that's the end of your covered period because you've used all the PPP money. So if it's 16 weeks, then the max you could apply for forgiveness for any individual that makes $100,000 or more is $30,769, unless you're an employee shareholder, a partner, a sole proprietor, because you have that finite limit of $20,833, okay? If you claimed payroll tax credits under the emergency paid sick leave or family and medical leave credit programs, those wages do not count for PPP forgiveness because you've already received the tax credit. So those were some credits that came out that if you paid people while they were home because they were diagnosed with COVID or caring for someone with COVID, you were entitled to some payroll tax credits. If you took advantage of that, those payroll costs are not a part of this program, okay? Something important that came out during the forgiveness process that was not apparent in the application process. Remember, when this came out in late March, the rules were changing every single day, sometimes 3 times a day. I can't even count how many interim final rules were issued in a 60-day period, probably 30 different tweaks to this within a 2-month period. So one of the things that came out in the forgiveness process is if you are a sole proprietor, an independent contractor, a partner in a partnership, or an S corporation shareholder, your health insurance premiums don't count. Well, they do count, but only to the extent that they get you to $100,000. Okay, so before we knew we had the $100,000 limit, and then our partners in the partnerships and our S corporation shareholders were adding their health insurance on top of that. And now we find through the forgiveness process that you are not allowed to do that. The theory with that is that for these individuals listed here, health insurance is part of their compensation, and compensation is limited to $100,000, so we can't add that on top of it, okay? So that was kind of a disconnect between the rules they made at first and then the rules that came out for forgiveness. And then furthermore, for independent contractors, sole proprietors, maybe some of you operating as single member LLCs and partners in partnerships, furthermore, you can't add your retirement benefits as part of your payroll costs. So again, something that came out in the forgiveness process. And importantly, because I get asked this all the time, your payroll costs do not include your employer portion of the Social Security, Medicare tax, or federal unemployment tax. Okay, that's yours on your own. That's not part of the computation of eligible funds, and it's not part of the computation of forgivable expenditures. Next slide, please. So another key definition that we need to be cognizant of full-time employees, because all these acts say that during this covered period, anywhere between 8 and 24 weeks, you have to maintain your full-time employees. So you have a base period that Paul will go through of what your full-time employee base was. And then the expectation is that during your period, that you're going to maintain that full-time employee headcount, okay? So a full-time employee is defined as anybody who works 40 or more hours a week. So for example, if I have 2 employees who each work 20 hours a week, I combine them together, they equal together 1 full-time employee, okay? So there's a couple of different computation methods available for FTEs, which may or may not be beneficial depending on your base period FTEs and depending on your covered period FTEs, but they do have some simplified methods available that have helped some of our clients. And owners don't count on either side, going in or going out. You kind of, this is just for your employees. We kind of ignore ourselves as owners. Next slide, please. So, key definition, it says that your eligible and forgivable expenses must be incurred and paid during your covered period, anywhere between that 8 to 24 weeks. So payroll costs are paid on the day that you pay them, but they're incurred when it's earned. So if you're paying somebody every 2 weeks and you pay them a week in arrears, it was earned during that 2-week pay period, but it's paid on the pay date, okay? So and for your non-payroll costs, same thing. It must be incurred or paid during the covered period, incurred and paid during the covered period, not or paid, because you're not allowed to prepay things, okay? Now, for purposes of this, you don't need to really have any anxiety over this or worry about it too much, because the law also says that if I incur a cost during my covered period, my 8 to 24 week period, but I pay it after my covered period, it's still good. It's still okay as long as you're making that payment on or before the next due date of when that bill would be due. So there are instances where you're paying stuff outside of your covered period, but you incurred the expense during your covered period. Those are still going to be good for you, okay? And again, we still just want to keep cognizant of that 60-40 test, that we must use 60% of the funds for payroll and payroll-related costs. Next slide, please. Okay, what can I use the money for? I've got the funds. What can I use the money for? I could use it for payroll costs that we've just gone at length over defining, okay? If you have a partnership, we recommend that you classify your payments to partners as guaranteed payments, because if you remember, payroll costs for partners in a partnership are their self-employment income from the partnership, and guaranteed payments are self-employment income. So we recommend that, okay? For those of you who may be sole proprietors of single member LLCs, we recommend that you actually take checks and write them out to yourself to prove payroll. We have had banks turn to our clients who operate as sole proprietors and say, prove to us you actually take the money out of the company. We need to see checks written to you, or we're not going to give you your PPP funds, or we're not going to give you your forgiveness. It's a wrong position. It's a completely inaccurate position. But look, at the end of the day, The banks are the ones who are controlling this process, and it's just easier to comply than it is to fight, okay? So that's why we have these recommendations for our clients. You can use the money for group healthcare continuation costs for people on sick or medical leave. You can use the funds for mortgage interest on loans that existed prior to February 15th, 2020. This includes real or personal property. So what we're saying here is typically when we use the term mortgage, our clients are saying, oh, I don't have a mortgage. I don't own the building. Expand your thinking on this. If you have a car that you have financed in the name of the business, that is a personal property mortgage. If you have equipment that you have financed in the name of the company, that is a personal property mortgage, okay? So expand your thinking beyond just real estate. You can use the funds for rents or leases that you had in existence prior to February 15th of 2020. So this is going to include your facility, your office space, your warehouse, your shop, whatever. It's also going to include equipment leases, copier leases, things like that. Think of all the leases you might have. Those are eligible expenditures. A note of caution, if you have a setup where you have an operating company and then you also own your building in a different entity and you have the operating company pay rent to the building company, you cannot use rent as an eligible expenditure, because if I have a related party that I'm renting from, then for purposes of this rent piece, I could only use the mortgage interest on the mortgage being paid to the related party. So that's kind of a little bit of an exception to the rent rule. I could use the funds for utility payments, which I had in existence prior to February 15th. That's gas, electric, water, telephone, and internet. Fuel for business vehicles qualifies as a utility, okay? Fuel only, not insurance, not repairs. You can get part of the cost of the vehicle if you have a loan on it. You can get the mortgage interest under mortgage interest above. But again, I get asked all the time, what about my insurance? What about my repairs? Those are not eligible expenditures, okay? Next slide, please. So the Consolidated Appropriations Act in December expanded the eligible expenditures retroactive to the first round of funding. So in addition to what we just went over, I could use these funds for payments for business or software or cloud computing services for my business operations, for tracking and processing payroll, for product and service delivery, for accounting of inventory records expenses, all these items that I've listed here. And I'm sorry that I'm breezing through it. We just have a lot of information to cover in a short amount of time. That's why all this is here for your reference. We also can use these funds for property damage costs. There was a lot of civil unrest in the country during the summer, and there was a lot of property damage. So if you had some property damage related to the civil unrest and that wasn't reimbursed by insurance or by any other means, then you can use PPP funds for that as well. Next slide, please. Covered supplier costs. This is a good one. Payments to suppliers of goods that are essential to your business. Okay, that's probably most of your goods if you are any type of business that is selling goods or producing goods. Okay, so two requirements: payments to supplier of goods that are essential to your operations and that are made pursuant to a contract or purchase order that was in effect at any time before your covered period. That one's the little hinky one that you got to get around. Certainly all of your suppliers of goods are essential to your operations, but if you don't have like blanket purchase orders or purchase orders in effect with your suppliers, you may want to consider getting that done right away so you can meet this little requirement that you have to have these in effect at any time before your covered period, okay? So again, we're giving you a little advice there, have an upfront conversation with the suppliers, consider entering into some vague, loosely defined blanket purchase order just to meet that requirement and check that box, okay? And this applies to you self-employed individuals as well. Next slide, please. Covered worker protection expenditures. So basically, if you're adapting your facility to deal with COVID and social distancing, those are going to be eligible expenditures. So think like, okay, things are getting back open now. We're all getting out a little bit. So think, you go to the grocery store, you see a plexiglass thing between you and the cashier. You see these everywhere. You see sanitizing stations. You see, all kinds of barriers that are around for social distancing. So these are going to be covered expenses as well. But again, I cannot stress enough that even though these seem like a Pandora and a wonderful gift, remember, these are all part of the 40% that you're allowed to spend. So you're going to have a finite cap on that. Next slide, please. I could also use the money to pay interest on any other debt obligation that I had before February 15th. If I do use the funds for that purpose, they're an eligible purpose, but they are not a forgivable purpose, okay? And I can also use the funds to refinance if I took an economic injury disaster loan. I briefly touched on that at the beginning, the EIDLs. So if you took an EIDL between January 30th and April 3rd of 2020, you can use the PPP to refinance that. If you did that, I would highly recommend that, because if you recall, EIDL loans are loans that you must pay back. It's a good interest rate. It's an extended period of time, generally 30 years, generally 3.75%, but it's not forgivable money. So if you did have one of those, I would highly recommend refinancing it with the PPP, because the PPP is forgivable money, okay? So again, 60% must be used for payroll costs. This cost must be paid or incurred during the covered period. For you independent contractors and sole proprietors, mortgage interest and utilities, you can only claim if you actually claim them on your tax return. And we have to throw in there, because it's thrown in all over the paperwork that you'll sign, that if you knowingly use these funds for any unauthorized purposes, then you could be held liable for charges such as fraud. Okay, next slide, please. So there's some stark differences between the second loan draws and the first loan draws that I'll go through quickly. Pretty much same eligibility rules apply. So there's nothing that makes you ineligible for round one other than if you have more than 500 employees, okay? The eligibility requirements are really simple. Round two has some other eligibility requirements, but round one, you can have 500 or less employees to be eligible for round one. Round two, you have to have 300 or less employees to be eligible. Round one, your maximum loan amount was $10 million. Round two, the maximum loan amount is now $2 million, okay? There are certain types of organizations that were left out of PPP funding when the CARES Act originally came out, and the CAA has now included them, 501c6 organizations, destination marketing organizations, et cetera. So some organizations that were previously not eligible for PPP funding have now been made eligible, but they must go through round one first before they can go through round two. If you are an employer with an NAICS code that begins with a 72, these are your restaurants, your bars, your hotels, your hospitality companies, okay? You have different rules that apply to you because you were the hardest hit. You can have more than 300 employees and you can have more than one location, and you get more money, which we'll go over in a second. So to be eligible for round two, you must have already received round one and completely used the proceeds, okay? Or you will use the proceeds before you get round two. So again, if you didn't get round one, you didn't miss out, you apply for round one now. Now, because of the covered period times the time frame you'll spend the money and the impending end of the program, if you did not get round one before, it is unlikely that you will get round two unless the program is extended beyond March 31st, which I don't know. I mean, internally, we think that's probably going to happen anyway, okay? You must have a revenue reduction relative to 2019 as compared to 2020 to be able to get a second round, okay? If you're a shuttered venue, concert hall, live music theater, museum, things of that nature, and you are applying for the shuttered venue grant, you are not eligible for PPP funds, okay? So some of you out there may be in line for a shuttered venue grant, you are not eligible for PPP funding. Next slide, please. To be eligible, go ahead, next slide, thank you. So to be eligible for PPP round 2, you must have a calendar quarter in 2020 where your revenues are at least 25% worse than your revenues compared to the same calendar quarter in 2019. Calendar quarters, okay? So I've had clients that say, hey, if I use February, March, and April, I qualify. And I say, yeah, you don't, because you must use calendar quarters, okay? That's how the law is written right now. It may be tweaked, it may be changed a little bit, but that's how the law is written right now. The further examples on this slide are if you were not in business all of 2019, then there's different steps you can take to make those comparisons to see if you have this requisite 25% reduction in revenues, okay? So this is here for your reference, and there are ways to go about figuring out if you're eligible if you were not in business all of 2019. Next slide, please. So revenue reduction is based on gross seats. Basically, if you take a look at your tax returns, your financial statements, it's basically going to be your top line, income figure that we're going to be basing this on. It doesn't include your gross receipts, don't include things like capital gains or PPP loan forgivenesses, or like if you're a retailer and you're collecting heavy amounts of sales tax, it does, because you're collecting them on behalf of the state, so it doesn't include those. But it's basically your top line revenue, okay? This last bullet point is extremely important, and you need to pay attention to this, okay? If you have affiliated businesses, which means that you have a small group of people who own more than one business, okay, together, if you own several businesses, for purposes of determining if you have the requisite revenue reduction, you must combine your businesses. You must consolidate your businesses. So if you own 3 different businesses, for purposes of seeing if you have 300 or more employees, you got to add them all together. For purposes of seeing if you have a 25% revenue reduction, you got to add them all together and do it on a combined basis, okay? It can be a good thing, it could be a bad thing. We have had instances where one, a person owns 3 companies, and one of the companies clearly qualifies, but when we combine them with the other 2, they don't. So all 3 of them are ineligible. We've had the opposite. We've had companies where one qualifies and the other 2 don't, but when we combine them as a group, they're under 20, their revenues are worse than 25% reduction, then they all qualify, even though the 2 separately did not qualify on their own. So kind of a double-edged sword, but you must combine them. And when you're thinking about control or affiliation, the most typical is common ownership, but there are other instances where you can be considered to be an affiliate of another business, even though you may not have common ownership. So if you think you are in that situation, I really advise you to discuss this with your professional. Next slide, please. So you have to substantiate this revenue reduction. You can't just go to the bank and say, hey, look at my sales this quarter this year and look at my sales this quarter last year. What we're seeing from a practical standpoint is that the banks are asking you to provide a full financial statement, a profit and loss, not a balance sheet, to demonstrate the 25% reduction. So let's say if it's the second quarter of 2020, they're going to want a side-by-side comparison of the second quarter of 20 versus the second quarter of 19, and not just the top line revenue numbers. They want to see the entire financial statement, and they're going to have you sign and date that, okay? If your loan is $150,000 or less, you are not supposed to have to provide that substantiation to get the loan, but you will need to provide it for forgiveness. In reality, the banks are making you do it up front, okay? They're not following the law. Like I said, the banks are running this program, they're administering this program, so they're the ones with the checkbook. it's just easiest to comply, okay? Your substantiation could be tax returns, financial statements, etc. For those of you out there who maybe have accrual basis books, but cash basis tax returns, then you could use either method, your accrual basis books or your cash basis tax returns, to see if you qualify. You could use either method, okay? And again, you must include all of your affiliates. Next slide, please. So the amount of money that you can get, we've defined payroll cost above. You get 2.5 times your average monthly payroll cost, capped at $10 million as compared to, $2 million as compared to $10 million from round one. So again, if you're applying for round one, your cap is still $10 million. You could use your 2019 or 2020 payroll to determine your average monthly payroll. For those of you with the business code that starts with the 72, which is again, your bars, your restaurants, your hospitalities, your things like that, you can use 3.5 times your average monthly payroll, okay? And the calculations are a little bit different for sole proprietors and partners in a partnership, not terribly different. And then if you operate a seasonal business, there are certain rules that differently apply to you, because you're not going to have a full year's worth of payroll. If you're a seasonal business, then there are special rules that apply to you, which we have outlined here. Next slide, please. So this, we really haven't seen banks jump on. It's, as you've gone through the process, maybe you've discovered that, hey, I really didn't get the funds I was entitled to in PPP1, and there's a provision in the law that allows you to go back and get a loan increase. The banks aren't really thrilled about this. They're not jumping all over it. So if you're in that situation, talk to your banker, but don't expect a miracle. Next slide, please. All right, so now I'm going to turn it over to Paul, and he's going to go over the forgiveness aspect of this. And I thank you all for listening to me.
Well, thank you, Gene. Gene always does a great job of breaking down some very complex concepts so that they're understandable. And we realize, there's a lot of information there. There are a lot of rules right now. Your head may be spinning a little bit. You guys might be saying, wow, these guys weren't kidding. This really is kind of complicated. That's okay. Don't let it intimidate you. You'll have the slideshow and the recording available so you can refer back to it. Most importantly, work with your advisors. They'll be able to help you to take advantage of the funds that you need for your business. So, this program is out there, it's available for you. And, it was put in place because the government wants you to have this money to keep people employed, to keep your doors open. And, the whole name of the game there is to get these loans forgiven, right? So you don't have to pay them back. So let's talk about loan forgiveness. These PPP loans will be forgiven to the extent that you use the proceeds to pay for the things that Gene just went over, the expenditures that are allowable. And you have to use up that money within whatever your covered period is. And, as we said, you have up to 24 weeks. You're basing your loan amount on 2.5 months of payroll. So it would be pretty hard to exceed 24 weeks for that. So you're going to spend all the money in your covered period. You're going to spend it on the allowable expenses. And then at the end of that period, you're going to submit an application to your lender for forgiveness, and you're going to submit all the related documentation, such as your payroll tax returns, your payroll registers, your canceled checks, your receipts, your account transcripts, vendor invoices. So they're going to want to see all that stuff. And you submit that along with the forgiveness application. The bank is going to have 60 days to decide on how much of your loan will be forgiven. They then notify the SBA within that 60-day period. The SBA has another 90 days after that to decide whether or not the loan is forgiven and how much that'll be. And then they make a payment to reimburse the bank for the loan. At that point, your loan is officially forgiven, and you don't have to worry about paying it back. But again, you have to apply for loan forgiveness in order to get it. We say it's a proactive process. It's not automatic. And if you want to avoid making loan payments, then you have to apply within 10 months after the end of your covered period. Otherwise, you'll have to start making payments of principal and interest. So you want to keep that in mind. Once the covered period's done, there really isn't much reason to drag your feet in applying for forgiveness. So, go ahead and get that done, get the loan forgiven, but you really do have 10 months to do it. Next slide, please. So there are some factors that will reduce the amount of your loan that is forgiven. You remember Gene referencing the fact that you have to maintain a head count there. So there are a few calculations. One of them is if you reduce compensation for any employee who's making less than $100,000 a year, and that reduction is more than 25%, and we're going to measure that against the most recent quarter that that person was employed. So if you reduce their compensation by more than 25%, then that is going to affect your loan forgiveness amount. It's going to reduce the amount of your loan that is forgiven. Now, similarly, if you don't maintain your average FTE count during your covered period, and that's an average that's compared to a base reference period. So we have two periods we can choose from. One is we look at February 15th, 2019 to June 30th, 2019, or we look at January 1st of 2020 to February 29th of 2020. So we're going to calculate what our average FTEs were in those periods, choose the one that's more favorable, compare that to our covered period. If we don't maintain our head count, then that can reduce the amount of our loan that is forgiven. Now, the good news is we have an opportunity to make up for that. All right. So if we restore the pay for those people that we reduced, if we restore our head count for people that we cut by the end of the covered period, then all is forgiven. All right, we don't have any reduction in loan forgiveness. So we can rehire the same people, or we can replace them with different people to get back to our FTE head count. But if we reduce pay, we have to increase the pay of those same individuals back to their pre-pay cut levels. Now, if you have a smaller loan of $50,000 or less, you don't have to worry about these factors, the FTEs or the pay reduction. There is no reduction in loan forgiveness amount if your loan is $50,000 or less. Next slide, please. So if we look at kind of the hurdles that we have to go over here to determine if our loan is forgiven, first is, did we spend all of the loan proceeds? Obviously, if we didn't spend everything, then we've got an amount that we're going to have to pay back to the bank. Did we spend it all on permissible expenditures? That list of expenditures that Gene did a very good job of going through. And was our split 60-40, 60% for payroll costs, no more than 40% for non-payroll costs? If we met that split and we spent all the money on permissible expenditures, then we can move on. Did we stay within 25% of compensation for all of our employees? Again, if we have those circumstances where we had to reduce somebody's pay more than 25%, that's going to affect our loan forgiveness amount. Did we maintain the same or greater number of full-time equivalents? If we didn't, then that's going to reduce the amount of loan forgiveness. If we did, if we answer yes to all those questions, you can see at the end, there we are doing our little happy dance with our pile of PPP cash that gets forgiven. Next slide, please. So we have a little example here. In the interest of time, I'm not going to go through the whole thing. This will be available for you to read through. The concept here is just keep in mind, if you have an employee where you reduce their compensation more than 25%, it's going to reduce the amount of your loan that is forgiven. So you can see here, ABC Company had a loan of $400,000. They had somebody whose pay they reduced. You can read through how the calculation is done. So they wind up with a loan that they have to pay back of $2,308, and they're forgiven $397,692. Next slide, please. Same thing here with full-time equivalents. So again, we're going to have a reference period. I described what those are: February to June of 2019 or January to February of 2020. You're going to calculate your average FTEs for both of those periods, compare that to your covered period, and that's going to determine whether or not you have to have any reduction in your loan forgiveness. We do have those safe harbor rules that I talked about, where if you restore your FTEs by the end of the covered period, then you don't get penalized. So keep that in mind as well. Let's go to the next slide. So again, here's an example. ABC had 36 full-time equivalents during its 16-week covered period. They calculate the February to June of 2019 as their average was 42. During January to February of 2020, they had an average of 40. So we're going to pick 40 because that's more advantageous to us. And then you do the calculation. So their FTEs were at 90% of their base period. That means 10% of their remaining loan is not forgiven. Now, there are some exceptions. Okay, if there's a reduction in your full-time equivalents because an employee refused to come back to work, you don't get penalized for that. Now, what you have to do is you have to make a bona fide written offer to the employees. You have to document that they refused to come back. They said, no, I'd rather just sit at home and collect unemployment, or whatever they're doing. And if they are on unemployment, you do have to notify the state unemployment agency of this circumstance, and then you're not penalized for the reduction in FTEs. If you have an employee that was fired for cause, just not working out, you had to let them go, or if somebody voluntarily resigned, or they requested a reduction in hours, somebody retires. These are all circumstances, they're normal business circumstances, but they're things that you don't necessarily cause, right? So it's not something that you're going to be penalized for. In those cases, that does not affect your loan forgiveness amount. If you can't rehire people who were employed, or you can't find similarly qualified employees, you're not going to be penalized for that. Next slide, please. And finally, kind of an additional catch-all rule. If you can't return to the same level of business activity because you were affected by a government shutdown order or a government stay-at-home order, and this could be a federal or a state or a local mandate, that is not going to affect your FTE headcount, and it won't affect your loan forgiveness amount. So again, things that are out of your control, they don't want to penalize you for. So it's only if you made a decision to cut employees and you don't restore that, then that could potentially have an effect on your loan forgiveness amount. Again, keep in mind, the whole purpose of this program is to keep people employed. So as long as we do that, we're going to be all good. Next slide, please. So the maximum amount of loan forgiveness is going to be the lesser of three numbers. And this is, you can do this calculation right on the loan forgiveness application. So, the most we can get forgiven is the whole PPP loan amount, right? We can't get forgiveness for anything more than what we borrowed. But there's a chance that the forgiveness could be less than that. So one of the calculations that we do is we have to take our payroll costs, divide by 60%, and that tells us were we within that 60-40 split. And as long as that number that we come up with is bigger than the loan amount, we're all good. There's no reduction. And again, the third category would be we take our total payments and we're going to reduce that for any of those pay reduction calculations or FTE calculations. So those are the three different factors that we can use. If you do have a loan reduction due to FTE situation, there are some ways we've come up with a formula that we use to help our clients in order to determine how much in additional payroll costs we can use to offset that. So there is the possibility of offsetting that with additional payroll costs. So that's something you may want to work with your advisors on if you think that you have an FTE situation. So again, non-payroll costs can't be more than 40% of your requested forgiveness amount. If you paid interest on those debt obligations that Jean mentioned that are not mortgage obligations, again, that's a permissible expense. It's not a forgivable expense. And any amounts that you use for any expenses that we didn't cover in the previous slides, if you decided to just go buy a car or something with your PPP funds, that's not going to be forgiven. Next slide, please. So this is a big issue, the taxability. You may have remembered hearing about this. So when the PPP was first announced in the CARES Act, Congress was very clear. We're not going to require people to pay tax on the loan forgiveness, because normally if you have a loan and it's forgiven, that generates taxable interest income for your business. It's called cancellation of debt income. So Congress said, nope, we're not going to have any of that. And IRS said, oh, fine, we're going to come in the back door then, and we're going to disallow the expenses. So, even though Congress told them they were wrong, they doubled down on it later in the year, issuing a revenue procedure that was based on, very faulty logic. So finally, the CAA came along and said, no, you know what? The expenses are deductible. The loan forgiveness is not taxable. You don't have any other basis adjustments to assets or any other factors that would normally occur when you have non-taxable income. So there is no tax impact whatsoever for having a PP loan and getting it forgiven. Now that's at the federal level. There are some states that looked at what the IRS was doing, and remember, states are all hungry for funds right now. They're hurting with their budgets too, and so some of the states are looking at that saying, well, you know what, we kind of like what the IRS said before, and so we're going to do what they call is decoupling from the federal treatment, and we're going to make some of this taxable. Wisconsin is a good example. If you do any business in Wisconsin, then you might have an issue with taxability of PPP expenses there. So if you're in a state, if you do business in multiple states, or if you're in a state that is decoupling, you need to be aware of that. So, and again, if you're in multiple states, make sure that you check each state you file in to find out what the proper treatment of these PPP loans is going to be. Next slide, please. There is a new forgiveness application that just came out for this streamlined loans, 150,000 or less. This is for both first draw or second draw loans. If your loan is 150,000 or less, you can use this one pager. Again, if the loan's in excess of $50,000, remember, you're going to have to do those FTE calculations and the compensation calculations to see if you have any reduction in the forgiveness amount. And then you have to put that on the application. But if you switch to the next slide, I know it's kind of hard to see, but we just wanted you to get a feel for it. It's a very simple application, one page, couple of check boxes, you sign it and you're good to go. So you can use this application. And again, if you had that PPP2 revenue reduction, you would submit your calculations along with this application when you apply for forgiveness to the bank. Next slide. So we are going to have to prove what we spent the money on. We highly, highly recommend you open a separate bank account for the loan funds. It makes things easier to track. It's very, very clear where the money went and when. You want to make sure you're keeping good records of all the checks that you write from the account, any electronic transfers that you make from that account to pay expenses. Keep receipts, keep invoices, even things like the little receipt you get at the gas pump for buying fuel for your business autos. Make sure that you hold on to those. If you have utility payments, for example, that you have on a credit card and you have those paid automatically every month, you're going to need to go in and get the invoices from your providers to submit with your forgiveness application. Keep detailed records of all your payroll payments. That's very easy if you're using a payroll service. If not, if you're doing payroll yourself, you want to make sure that you have good records of all the payments of payroll, how things are calculated. Especially keep in mind that that portion of the payroll taxes that is the employer portion, that's not eligible for PPP. So if you're using a payroll service, a lot of times what they'll do is they'll hit your account twice. The first draw is going to be for the net checks that they're giving the employees. Second draw is going to be for all the taxes. That will include the payroll taxes that the employer pays, which are not eligible for PPP. So if you have that coming out of, say, a separate payroll account, we recommend that you make a transfer to cover that portion from your operating account into the payroll account, so it's very clear that you're not paying those funds with PPP money. Next slide, please. So you want to keep detailed records of changes in your workforce, not just the fact that the workforce changed, but why. Somebody retired, I had to let somebody go for cause. You have very detailed and complete records of those things. So again, that does not penalize you in terms of your FTE calculation. And you're going to submit all these copies of records along with your bank statements to your lender when it's time to apply for forgiveness. Keep in mind, it's possible there could be some sort of audit process in the future for these PPP loans. We don't know if that's going to happen. We don't know what it's going to look like. You want to make sure that you maintain all these records for an adequate period of time. We recommend at least 4 years to do that. Next slide. So if your loan's not forgiven, it's going to wind up being a 1% loan. If there's some portion that is not forgiven, it's going to be repaid at 1%. The term is over 5 years now. If you got an early loan, the term initially was 2 years. Congress expanded that, gave banks the opportunity to renegotiate. So if you had one of those early loans and you're still at a 2-year term, you may want to go back and talk to your bank about renegotiating that to the existing 5-year term. I haven't heard of any banks not doing that. You got no payments of principal or interest for 6 months from forgiveness. Interest still accrues at that time, and none of the typical SBA guarantees and fees apply. Next slide. We just want to mention this. We said we weren't going to cover the EIDLs in detail, but there is the ability, they have a non-taxable forgivable grant up to $10,000. So if you apply for an EIDL, you can request $1,000 per employee emergency grant. It's up to $10,000 maximum. And that's can be used for working capital. If you qualify, the grant's available even if you get a PPP loan. It's not going to reduce anything with regard to your PPP forgiveness. It does not have to be repaid, and it's not taxable. But keep in mind, this isn't handled through the banks like PPP. This is something you apply for directly on the SBA website. And if you are applying for an EIDL and you want some suggestions on that, we do have recommendations for completing those applications. We can share those if you need help. Next slide, please. So we do have a detailed tool that we've developed to track our spending for PPP loans. It keeps track of everything very nicely, categorizes it, helps you figure out your loan forgiveness amount. It's something you can provide to your lender with the forgiveness application to make things very easy and as streamlined as possible. Bottom line is, work with your advisors. Make sure you have a team around you to help you. You don't have to do this yourself. Yes, it is complex. Yes, it's easy to get off track, but if you're working with people who know what they're doing, they're going to help you. And if you have a good banker, they'll help you too. So again, if you have any questions or you want to use that tool that we have developed, you can feel free to contact us. And with that, we're going to open it up for questions.
Wow. Thank you so much, Jean and Paul, for all that helpful information. That was a lot of information. You're right, Jean. We shouldn't do this on our own. For me,
Right.
I certainly need a professional like you and Paul. So let's proceed with the Q&A. Again, to our Zoom attendees, if you have any questions, please type them into the Q&A box. And to our FB Live viewers, please type your questions in the comment section on the live feed on PACC-DC's Facebook page. All right, so we do have questions here from Elliot. Do you know when lenders are going to accept the new PPP loan calculations using gross income and not net profit?
Well, I don't understand the question, because gross income only comes into play to prove that you've had a 25% or more revenue reduction in a quarter from 20 to 19. That's the only time that gross revenue comes into play in PPP whatsoever. And gross profit, net profit, only comes into play in PPP for those people who are operating as sole proprietors or Schedule C taxpayers. So they're really kind of not part of the process to begin with.
Okay, so Elliot, if you're still online, maybe you want to clarify that. We'll go to the next question. Melissa, from Melissa. I understand that owners don't count for FTE calculations. However, if an owner is a W-2 employee as well, do they count?
No. No, the owners are taken out of the equation, both on your base period FTEs and on your covered period FTEs. Owners don't exist.
Oh, poor guys.
Yeah, I know. It's goofy, but it's too easily manipulated.
True, that's true.
Yeah.
This is from an anonymous attendee. Can you please review what you mentioned regarding incurred and payment timelines over the relevant period? For example, if we pay 3 months of rent in 1 month, is counted towards the 40% of non-payroll expenses?
Well, if you're prepaying, if you saw on the slide and go back in the deck, prepayments are not allowed. I mean, look, I guess if you're prepaying 3 months of rent at once and you're going to end up using a 12 or 14 week covered period, then really over that 12 or 14 weeks, did you really prepay? Because that covers 3 months. Got it? So like if I'm getting to the end of my covered period and I prepay the next 3 months, those are not going to count, only within the covered period.
Okay, I got that. Even I got that.
Yeah.
All right. If your company has enough funds before the loan to take care of payroll, utilities, rent, other costs, and you deposited the PPP loan proceeds into your savings account and did not touch during the covered period, would that meet the requirement that you used the loan periods for company's expenses?
Go ahead, Paul.
No, I would say I would say it would not, because it's pretty easy to track that you put that money into a separate account, right? So if you deposit it in a savings account and you don't touch it, then technically you can't prove that you used those funds for any purpose. And I think in that situation, you probably also have an issue with the certifications. Remember, you need to certify that you needed the money. If the company's healthy and you've got cash to cover operating expenses, to cover your payroll, to pay your expenses, then that really doesn't meet the spirit of the program. This is to assist businesses that are struggling and need money to keep the doors open, need funds to continue to pay their payroll. So in that event, I think you would probably have an issue with really truthfully signing those certifications on the loan application.
Well, it could be a situation where you actually personally advanced the funds for the company.
Well, that's a different story.
Well, the PPP
Right.
That's a different story.
undergoing the processing.
Right. That's a different story. I mean, but I agree with Paul. You should take the funds, you should deposit them into your checking account. That way, we always say money is fungible. If you have excess funds and occasionally move some money into your savings account, well, if you originally deposited the funds into your checking account or your operating account, and then you can show payroll and show paying bills and things like that, and hey, I have a little excess cash here and there and put it in my savings, I don't have a problem with that. But taking the PPP funds and directly putting it in your savings or putting it in your checking and immediately transferring the exact same amount into your savings, that's probably going to be a problem.
True. Okay, next one. Are personal family leave receipts pay received while you were taking care of sick family members that are shown on 1099-G taxable income?
1099-G is unemployment payments. You get a
Right.
1099-G when you get unemployment benefits. So I'm not really understanding the question.
Yeah, that wouldn't have anything to do with the PPP program. That would be a government payment if it's on a 1099-G.
Yeah.
Yeah, Bert, you may want to clarify that. Okay, next one. I assume the PPP loan forgiveness is a taxable income.
No, just as Paul said, the CARES Act itself specifically said that when these loans are forgiven, it won't be taxable income, because what we needed to address, or what Congress needed to address, is typically if you owe somebody money and they forgive it, you have something called CODI, cancellation of debt income. Okay, So Congress specifically addressed that issue and said, hey, and when we forgive you this, it will not be CODI, will not be cancellation of debt income, it will not be taxable. Then the IRS about a month later said, that's fine, we get that, we have no problem with that. But the expenses that you pay that are forgivable, we're not going to let you deduct. And that came out like in April, and then they doubled down on it in November. And then the Consolidated Appropriations Act said, nope, IRS, you got it wrong. When we said free, we meant free. So when it's forgiven, it's not taxable. And all the expenses that you use to for PPP forgiveness are fully deductible. You got it wrong. When we said free, we meant free.
Good. That's good news.
Yeah.
Can we get a copy of these slides? Yes, you can, John. You can contact us, eBoard. Oh, I'm sorry. It's what do we use as our email? Christoph? We'll put it on the chat box where you can get a copy of the presentation. Okay. Here's another one. I run a business with part-time employees. In 2020, my average W-2 monthly employees was 17. I currently have 23 W-2 employees part-time on my staff. My FTE was and is less than 20. Can I apply for PPP round 2 currently, or do I need to wait for March 9? I've already completed PPP round 1.
Okay, so for purposes of applying for the funds, it's kind of goofy because for purposes of forgiveness, we care about FTEs. For purposes of applying for the funds, we care about bodies, period. So if I have 600 employees who are all half-time people, a logical person would say that's 300 FTEs, I qualify, but the SBA will say 600 is 600. So if you currently have less than 20 employees, and it doesn't matter if they're full-time or part-time, just the number, then during this 2-week window, you are eligible to apply.
Okay. All right, next one. So when should we expect notification that our round 1 PPP loan has been forgiven? After 2 months lender review or 3 months SBA review?
Well, sometimes it'll be as quick as 2 months. We've certainly seen the SBA process applications that quickly, but your lender has up to 60 days. That doesn't mean they're going to take the whole 60 days, but they have up to 60 days to decide and notify the SBA. The SBA has up to 90 days from that. So, your maximum time period there would be 150 days, right? But we haven't seen it taking that long. Usually,
no, we're seeing them
a couple of months
within tops, maybe even 5-6 weeks. Yeah.
Right.
Okay, we do have some questions that we received beforehand. If payroll or non-payroll costs were incurred before the covered period, but paid during the covered period, are those costs still eligible for loan forgiveness?
The answer is yes, some of them are. So certainly for non-payroll costs, if you have bills that were incurred prior to the covered period but paid in the covered period, guidance was issued that says that those can be counted. For payroll costs, typically those have to be incurred and paid in the covered period, or incurred in the covered period and paid, immediately after. So, if your covered period is 8 weeks and your last payroll covers that 8th week and you're not going to pay it for, another week after that, that's okay. You can count that because it was incurred in the covered period. But typically payroll that's incurred prior to the beginning of your covered period, we wouldn't count. And again, you have 24 weeks, so you're certainly going to have plenty of time to use up those funds.
Yeah, it really shouldn't be difficult to use up the funds given the expanded covered period now. It really shouldn't be. I mean, the one thing that they're really just trying to prevent is you prepaying things.
Right.
Okay. Next one, aside from salaries covered by loan forgiveness, can a borrower pay bonuses, lost commissions, or any form of incentive pay? And would those qualify for loan forgiveness?
Oh, yeah.
Those-
Pay is paid. Yeah,
Yeah.
pay is paid. Absolutely. Again, remember, we have the $100,000 limitation and we have the owner limitation, which is 100,000, but computed separately. So, living within those limitations, yeah, pay is paid.
Okay. What happens to any loan balance after SBA remits the forgiveness amount to the lender? So I guess you didn't get the full forgiveness.
Right. So if the person asking the question means that not all of the loan was forgiven, then they fall into that situation where they have an amount that needs to be repaid to the bank. So that's at 1% over the 5 years, and they'll have a 6-month moratorium on payments. They'll still accrue interest, but they won't have to start making principal and interest payments for another 6 months, and then they have 5 years to pay it back.
Right, but really talk, if you're in that situation, please talk to your advisors, because we've had people who thought they were in that situation, but there's methods of overspending out of your own money on pay. I mean, there are ways to cure that. So really be sure that you have explored all of your cure options before you just say, I have a loan.
Right, and even if it's because of FTE calculations, we have people who thought that they had an FTE problem, but when we looked at it more closely, we found out, well, you know what, you really don't count these people, and so your FTE calculation wasn't really reducing your loan forgiveness amount at all. So again, you need to work with some competent advisors to help you navigate all of these rules.
Okay. Next one, we have, can small business concerns with more than 300 employees be eligible for PPP2 loan?
For PPP2?
PPP2.
Right. So again, unless you're in one of the businesses that has a code classification that starts with 72, at 300, once you're above 300, you're done. You're not eligible.
Or
and remember, this includes affiliates too.
Or if you fall into one of those categories, SBA has a whole table that they publish of what they consider a small business, and so really it's the larger of that 300 or what they have in their classification table. For some manufacturing companies, the limit is 1,000 employees. For other types of manufacturing classifications, it could be 1,500 employees. So it really depends on what your NAICS code is. As Gene said, if you're in that 72, you get relief according to the law. If you're in some other categories, the SBA has classifications that could allow more than 300 employees. So you really need to check on that to see.
Right.
Yep.
But in general, manufacturing, which is 51, starts with 51s generally, depending on the type. So, I mean, in general, it's the 300, but there are some exceptions to that. Yeah.
Okay. Next one, can a lender sell a PPP loan into the secondary market?
Yes.
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 Okay. All right. When should I apply for PPP loan forgiveness?
Well, you have, as Paul said, you can apply for forgiveness up until the end of the term of your loan. Okay. If you don't want to make payments on the loan, then when your covered period ends, you have 10 months from the end of your covered period to get that application in. Okay. If you don't get that application in within that time period, you are required to start making payments. But you could be making payments and submit the application later and get forgiven, and then you will be refunded the payments that you've made. I don't know why anybody would do that, but you can.
Yeah, technically you could. We had there were a lot of businesses that towards the end of last year waited because of the uncertainty about the taxability, and everybody wanted to see what was going to happen before they applied for forgiveness. That issue has been solved, and really we don't know of any reasons why you should wait. now.
Well,
I mean,
no, but now we've backed off again a little bit because the topic that we didn't address today, the employee retention credit, which plays into the wages that you use for PPP forgiveness. So what happened is once they made the legislation that, hey, this is free money, I'll say, okay, let's open the floodgates again. It's like, whoa, wait a minute. Now that they've freed up the ERC for those people who have PPP loans, it's like, let's rethink this, because now if you are eligible for the employee retention credit, and there's eligibility requirements for that, then I don't want to use only payroll for PPP forgiveness. I want to push that other 40% of allowable expenditures. I want to preserve my payroll for the ERC.
absolutely.
So, we go, then we back off, and then we go, and then we back off, and it's, not us. It's, as they change the law, it's like, oh, wait a minute.
That's true. And the thing that Gene's referring to there also is that there are planning opportunities around this employee retention credit. I know we didn't get to cover that in detail today, but if you're interested in learning more about that, contact PACC-DC, let Alma know. We certainly would be willing to come back and do another webinar just focused on that, because there's potentially a lot of money involved there for you. Cash that you can hold on to, not having to make payroll tax deposits, even getting the IRS to write you a check back. So it's a great opportunity. There's a lot of interplay between that credit and the PPP. And so we encourage you to, look into that, learn the rules, work with your advisors. And as I said, if there's enough interest, we're happy to come back and cover that topic as well.
Okay, we do have a few more questions here. If you guys okay to stay a little longer?
Sure.
This is somebody's afraid, I guess. Are there still PPP funds available today for both rounds 1 and 2?
Oh yeah, but remember, it's the only reason we segregate round 1 versus round 2 is you can't get round 2 until you have gone through round 1. Okay, so yeah, there's funds available today. And, like we said, there's nothing official. We don't speak on any, on any official statement, but our thinking in the firm, or certainly Paul and I who head up this piece that we do for the firm, our thinking is March 31st is going to come and they're going to extend it again, maybe even throw some more money into it. I mean, that's kind of our thinking right now. So again, they are open, they are available. But if you didn't get round 1, you got to go through round 1 first, which is fine, because round 1 doesn't have the requirement that I have to prove a 25% reduction in revenue. Round 1 gives me up to $10 million, not $2 million. Round 1 lets me have 500 employees, not 300 employees. So it's okay.
Okay, good to know. Does loan forgiveness affect our credit rating?
No.
Where will the recording of this session be available? We will have it on Facebook. We will be posting that, our page, PACC-DC. If we used up all the PPP loan on week 20, should we put 24 weeks payroll plus utilities cost on the forgiveness application?
Well, if you use it all up by week 20, then the end of your covered period is going to be week 20. I mean, if you have a compelling reason to run it out to week 24 and you don't have any of the FTE issues or anything like that, that's okay too. But generally, if you've exhausted the funds by week 20, you're generally going to consider that the end of your covered period.
Yeah,
So
really,
again,
it's when you're done spending the money.
Yeah, I mean, you may have extenuating circumstances that you may want to expand that for, but that's on a case-by-case basis. Generally, when you're done spending the money, you're done.
Okay. And the last one here is, yes, please do another webinar on ERC. So we may be calling you back, guys.
We're happy to do that.
Okay, thank you for all your questions, folks. Unfortunately, we will need to bring the webinar to a close. If you have more questions, please email them to paccdc.eboard@gmail.com. Before we go, I'd like to invite you to PACC-DC's upcoming events. We have our March as our designated tax prep month. Please join us on March 4, 6 p.m. Eastern for our March meet and greet special wine and taxes. Jean and Paul, you're invited here. It's a special event for this tax season sponsored by Mass Mutual Commonwealth. Register for the webinar and you will get a free wine tasting kit from Burrow Wines.
Two of my favorite things, wine and taxes.
Well, one of them.
You need the wine to do your taxes. Please join us for this informative and definitely fun session. And on March 18, 4 p.m. Eastern, still on the tax prep theme, JNC Financial Services will give us helpful information on how to save on our taxes. I think all of us would definitely want to save money on taxes. So do join us March 18, 4 p.m. And also save the dates, April 1 and 16, more fun events from PACC-DC. Details to follow. Thank you again to our speakers, Jean Barinholtz and Paul Wilkin of KRD.
Thank you.
www.krdcpas.com. Also, don't forget, National ACE is offering complimentary business consulting. www.acesmallbusiness.org. We hope you learned a lot from this webinar. Shout out also to Janet Alikpala of ACE and Anna Reyes of KRD Limited for helping facilitate this webinar. And Christoph Innocentes of Kaji Design Studio for poster redesign and IT. Thank you again to our partner ACE. We look forward to more projects with your group. And of course, thank you to our Zoom attendees and FB Live viewers for joining in. Until next time, good evening, Jean, Paul, Christina.
Thank you. Thank you, everyone.
Thank you, everybody.
Thank you. Good evening. Bye.